Today we will discuss the importance of being insured. The discussion in this lecture includes information about how insurance works and why it is a good idea to be covered by a policy. Imagine you own your own house and you wake up one morning to find quite the mess. It seems like a pipe is broken in your basement and the basement has flooded. After a few days, the mess is finally cleaned up and you are left with a bill. $4,000! Now think about the next $4,000 you will receive and where you are planning to allocate that money. Make a list of these items and circle the ones that are important to you. Don't forget about the necessities. As you can see, even with a steady job, $4,000 is way too much money to allocate to an expense all at once. This is why we have insurance. To get an idea of how insurance works, let's first discuss what it is. Here's the definition of insurance. An agreement in which a person makes regular payments to another party who in return guarantees compensation for a specific loss to the person making the regular payment. One important piece of information to highlight here is that it is an agreement. The person being insured is making a regular payment, usually monthly or yearly. This is called a premium. In return, the insurance company or agency will cover the financial losses of that person at the time of the loss occurs. This means that throughout the span of the time you are paying home insurance, an accident can be paid for in full by the insurance company, and you won't have to pay out of pocket at all. This loss compensation is called a claim. To further understand how insurance works, let's work through this example. Bob has an insurance plan on his car which he pays $120 a month, while Nancy has an insurance with the same company and pays $95 a month. Let's assume that Bob and Nancy just started their insurance policies in January 2014. While Bob doesn't get into any accidents in 2014, Nancy gets into one in March. Luckily, the accident wasn't her fault, so the insurance company is paying for the $500 in damages in full. Hold on a minute. This means that by March, the company has only collected $285 from Nancy. How is it that the full cost of her accident is covered if they have not collected this much money from Nancy yet? The answer is the redistribution of risk. Since many individuals are assuming risk for themselves and paying a premium to do so, the insurance companies have enough capital to cover the financial loss of an individual. An example I like to refer to is a snowshoe. Think about how it distributes the weight so that the small area of impact between your foot and the snow doesn't cause your foot to sink through. Looking back at our example with Bob and Nancy, a similar phenomenon is happening. Although the company has only collected $285 from Nancy, they've also collected $360 from Bob. With the funds pulled together, the company has $645. So since Bob assumed the risk for himself and paid the amount necessary to do so, the company has enough money to cover Nancy's losses right at the time of her accident. When the risk is spread over many individuals, the impact on any individual is minimized. This is a really simple example where the insurance company only has two policyholders, Bob and Nancy. In reality, insurance companies have many clients who are organized into pools of similar risk. As you may have noticed, Bob and Nancy pay different rates. This is because based on some of Bob's previous claims, he has a higher probability of getting into an accident. Because of this, he is assuming more risk than Nancy by paying a higher premium. Let's look at an example that may be more familiar to you. You and your roommates keep a jar of spare change in your room. At the end of the day, each of you deposits any spare coins that might be in your pocket. When payday is approaching, it is not uncommon for you and all of your roommates to be low on money. This is when you are allowed to take change from the jar to help with whatever purchases need to be made during that time period. This is a very close representation to how an insurance company works. Now that you understand insurance, you might be thinking, I'm a very careful driver, and I don't foresee getting into any accidents. This means that I probably do not need insurance. The truth is, the probability of getting into an accident is a lot higher than you would expect. And when the accidents happen, you don't want to risk going bankrupt because of it, especially if it wasn't your fault. Let's consider another example. Sam is a grad student who follows a strict monthly budget as outlined below. He pays all of his bills on time and is saving for a new car because his doesn't have a radio and it could break down any day. Now imagine Sam gets into a car accident and does not have car insurance. The cost of his damages are $300. Given Sam only has $100 of spare cash, what is the best way for him to pay for the damages? Let's assume Sam lives a few miles from campus and has no access to public transportation, so he needs his car as soon as possible. Sam will be $200 short of making his payments with his current budget. Even if he decides to use the $50 he usually puts in his savings account, which will delay how soon he can afford his new car, he will be $150 short. To pay for the damages, he will have to delay his budget for his new car and be late on his monthly payments. Now let's imagine Sam did have car insurance at the time of his accident. Instead of keeping that $100 in spare cash every month, he put it towards an insurance plan for his car. Although he no longer has that spare cash to use for whatever he wants every month, he has the security of knowing his budget will be enough to pay his bills on time. In addition, it won't take him any longer to be able to afford a new car.